Welcome back to our channel. Today we are going to delve deep into one of the most anticipated events in the cryptocurrency world, Bitcoin halving. This comprehensive guide will cover everything from the basics of Bitcoin halving to its market implications and historical impacts. So let's dive right in. Introduction to Bitcoin halving. First, let's start with the basics. What exactly is Bitcoin halving? Bitcoin halving is an event that occurs approximately every 4 years, or more precisely, every 210,000 blocks mined. During this event, the reward for mining new blocks is halved, meaning that miners receive 50% fewer Bitcoins for verifying transactions. To understand why this happens, we need to go back to the origin of Bitcoin. When Bitcoin was created by Satoshi Nakamoto in 2009, the reward for mining a block was set at 50 Bitcoins. This reward is programmed to halve every 210,000 blocks to control the supply of Bitcoin and ensure scarcity, similar to precious metals like gold. Historical overview of Bitcoin halvings. Now that we understand what Bitcoin halving is, let's take a look at the history of past halving events and their impacts on the market. The first Bitcoin halving occurred on November 28, 2012. The block reward was reduced from 50 Bitcoins to 25 Bitcoins. This event marked the beginning of Bitcoin's journey to mainstream recognition. Following the first halving, Bitcoin's price saw a significant increase, rising from around $12 to over $1,000 in the following year. The second halving took place on July 9, 2016. This time, the block reward was cut from 25 Bitcoins to 12.5 Bitcoins. Leading up to this halving, Bitcoin's price experienced a steady rise, and after the event, it continued to grow, eventually reaching nearly $20,000 in December 2017. The most recent halving occurred on May 11, 2020, reducing the block reward from 12.5 Bitcoins to 6.25 Bitcoins. This event garnered significant attention from both the crypto community and mainstream media. In the months following the 2020 halving, Bitcoin's price surged, reaching an all-time high of over $60,000 in early 2021. These historical patterns suggest a strong correlation between halving events and subsequent price increases. However, it's important to note that many factors influence Bitcoin's price, and halving is just one of them. The mechanics of Bitcoin halving. To understand the implications of Bitcoin halving, we need to delve into the mechanics of how it works. Bitcoin operates on a decentralized network of computers called nodes. These nodes verify and record transactions on a public ledger known as the blockchain. Miners are individuals or organizations that use powerful computers to solve complex mathematical problems, a process known as proof of work. When a miner successfully solves a problem, they add a new block to the blockchain and receive a block reward in the form of newly minted Bitcoins. During a halving event, the code that governs Bitcoin's blockchain reduces the block reward by half. For example, if the current reward is 6.25 Bitcoins, after halving, it will be reduced to 3.125 Bitcoins. This reduction in rewards affects the incentives for miners, as they receive fewer Bitcoins for the same amount of work. The halving process is automatic and programmed into Bitcoin's code. It ensures that the total supply of Bitcoin gradually approaches its limit of 21 million coins. By reducing the rate of new coin creation, Bitcoin halving introduces scarcity, which can drive up demand and potentially increase the price. Economic principles behind Bitcoin halving. Bitcoin halving is grounded in fundamental economic principles, particularly the concepts of supply and demand. Let's explore how these principles apply to Bitcoin halving. The law of supply and demand states that if the supply of an asset decreases while demand remains constant or increases, the price of that asset is likely to rise. In the case of Bitcoin, halving events reduce the rate at which new Bitcoins are introduced to the market, effectively decreasing the supply. Host. This reduction in supply creates scarcity, similar to precious metals like gold. As Bitcoin becomes scarcer, investors may perceive it as more valuable, leading to increased demand and higher prices. Additionally, the fixed supply of 21 million Bitcoins creates a sense of finite availability, further driving demand. Bitcoin's deflationary nature contrasts with traditional fiat currencies, which can be printed in unlimited quantities by central banks. This difference makes Bitcoin an attractive store of value and a hedge against inflation, contributing to its growing popularity among investors. Impact on miners and mining industry. Bitcoin halving has a profound impact on miners and the mining industry. Since miners receive fewer Bitcoins for their efforts after each halving, their profitability is directly affected. Let's explore these implications in detail. Miners invest significant resources in hardware, electricity, and maintenance to secure the Bitcoin network. When the block reward is halved, their revenue decreases, making it more challenging to cover operational costs. As a result, only the most efficient and well-funded miners can continue to operate profitably. This dynamic can lead to changes in the mining landscape. Less efficient miners may be forced to shut down, reducing the overall hash rate, the total computational power securing the network. However, as weaker miners exit the market, the mining difficulty adjusts to ensure that new blocks are still added approximately every 10 minutes. Interestingly, past halving events have demonstrated that despite initial concerns, the mining industry tends to adapt and recover. Advances in mining technology and the increasing value of Bitcoin can offset the reduced block rewards, allowing miners to remain profitable in the long run. Market sentiment and psychological impact. Market sentiment and psychological factors play a significant role in how Bitcoin halving affects the market. Halving events often generate widespread anticipation and excitement within the crypto community and beyond. Let's delve into the psychological impact of Bitcoin halving. Leading up to a halving event, discussions and speculation about potential price increases dominate social media and news platforms. This heightened attention can create a sense of urgency among investors, driving them to buy Bitcoin in anticipation of future gains. The fear of missing out, or FOMO, is a powerful psychological driver. When investors see others buying Bitcoin and the price rising, they may rush to purchase it themselves, further fueling the upward momentum. This collective behavior can lead to significant price increases both before and after the halving event. However, it's important to recognize that market sentiment can also lead to volatility. Sudden price spikes may attract short-term traders looking to capitalize on the momentum, resulting in price swings. Long-term investors should be prepared for potential fluctuations and remain focused on the broader trends. Comparative analysis of previous halvings. To gain a deeper understanding of Bitcoin halving and its implications, let's conduct a comparative analysis of the previous halving events. By examining the patterns and outcomes, we can identify key insights and trends. First halving 2012. The first halving reduced the block reward from 50 Bitcoins to 25 Bitcoins. At the time, Bitcoin was still relatively unknown to the mainstream audience. Following the halving, Bitcoin's price experienced a gradual but substantial increase, reaching over $1,000 within a year. This event marked the beginning of Bitcoin's journey to wider adoption and recognition. Second halving 2016. The second halving lowered the block reward from 25 Bitcoins to 12.5 Bitcoins. This halving occurred during a period of growing interest in cryptocurrencies. Leading up to the event, Bitcoin's price showed steady growth. After the halving, the price continued to rise, culminating in the famous bull run of 2017, where Bitcoin reached nearly $20,000. This period saw increased media coverage and a surge in retail investor interest.